afternoon, good evening, traders from across the globe, and welcome to Short-Term Trading Live with Oscar's 707th installment of these educational videos. Traders, futures trading is risky and can cause substantial financial loss. If you do not have risk capital to lose, you should not be in this game. For you traders who are, a couple of things on the board I would like to discuss. First of all, this video is being filmed on Monday night for Trading Tuesday, that is March 15, 2011. Traders, on the board, I have a couple of things. Let's go down to the bottom. The 65% rule, I told you I would keep you informed on that. So tonight I will show you where we are at in the charts with that 65% rule. We'll look at a couple of examples and then we'll see what it looks like could happen for the rest of the week or rest of the month. What else is on this board? Traders, this says grassroots movement, and I want to start one right here, right now. For you traders that agree with this, I started it this evening. I was blessed, and thank you, Oriel Morrison. I was invited on CNBC's Cash Flow from Australia, and they allowed me to speak my piece a little bit. And traders, here it is. Big question. Why on earth are speculators allowed in the crude oil market? I am a guy that grew up on the exchange, right? I grew up standing next to that crude pit constantly, and I have to tell you, it is unfair at this point in our time that any speculators are allowed to just step into crude oil and buy up something that wrecks world economies just so that their balance sheets can look better to their investors. What do I mean about that? Right now, traders, there's about a 40-some-odd billion dollar bet. It's probably a little higher at this point, that the price of crude will go higher. That bet is made by hedge funds, commodity pool operators, commodity funds, ETF funds, and some of course, hedge funds, and some of, if not all, of the oil companies themselves. They have about a 40-some-odd billion dollar bet on the upside in crude. And it's going up, and it is wrecking world economies. Why on earth is anyone allowed to go to that crude market unless you are going to take delivery and prove that you are going to take delivery? There's plenty of demand in this world for crude, so I don't want to hear any argument about liquidity because you do not need speculators like us in the crude market to create liquidity. Just about every planet or every country on this planet uses crude. Brazil says they don't. I'll bet you even they use some. Every country uses crude. There is plenty of market for these oil producers to just bring it to the exchange, drop it off, and allow countries to buy it without speculators putting 40-some-odd billion dollars, which is a small amount of money, that drives this thing to the point that it wrecks world economies. Listen, imagine this. Bernie Madoff, that you know what, that we all hate, that stole from people. He stole $50 billion. That's about 10 or 8 billion more than the bet on crude. Do you know what happened to our markets and world economies? Nothing. Some people lost their minds and lost their money, and you know what? Someone jumped out the window. However, that did not ruin world economies, and that's a bigger bet than we have on crude right now. So why is something smaller than what Bernie Madoff went to jail for allowed to wreck our economies? This is BS. This has to stop. If you can think of a reason why speculators should be allowed into the crude market, you tell me. I want whoever agrees with me to start writing letters. Let's start a grassroots movement to stop speculators from driving the price of crude higher. I think it's unfair. I'm a speculator myself. I don't want to be allowed in that market. You shouldn't be allowed in that market. If you do not have proof you're taking delivery, why should you be allowed to put a bet on wrecking world economies? Imagine one other situation or scenario. Imagine if instead of crude oil, which of course you have gas and you have heat, but it's all byproducts of crude. Imagine if there was only one market called soybeans, and wheat, corn, oats, and every other thing out there that's tradable was a byproduct of soybeans. Do you think they would allow us speculators to drive the price of food up so high that the world couldn't eat? Of course not, right? There would be regulations against that one food market. Well, we have a crude oil market. It is one energy market, and it can wreck the world's economies. Please help me get this movement started. I've started it on CNBC. I will go on anybody's show that I can and keep this movement going. If you agree with me, help me get something started, traders. Tomorrow morning, the CNBC interview will be on our site. Please look at that. And if you agree with me, let me know, and let's get this thing started. We need to start this movement. We need to get speculators out of crude. I'll bet you crude is worth 40, 30, 40, maybe $50 a barrel if you could take the specs out of it. That needs to be done. Congress, our senators, we should write to everybody. If the government is listening, imagine if someone in the government watches these videos. Please think about this. Help us get the speculators out of the crude market. All right, traders, enough of a rant on that, but I hope some of you agree with me. And I'm a commodities trader that is so far opposite of what my position should be. But I hope that this planet survives and our country survive. And I don't want to make money or watch others make money on destroying world economies. All right. Now, where are we next? Japan. Oh, my goodness. What can we say? Our hearts, our prayers, everything that's good about us goes out to Japan. Traders, I lived through Chernobyl. Not that I was there, but I remember I was a trader through it, and the news got worse every day. The news here is going to get worse every day for a while. I have been saying this since Friday that you cannot have a nuclear reactor meltdown without a big problem. And now we don't just have one. We have a big problem there in Japan. They need our help. They need the world's help. But this will pass, believe it or not, as horrific as this is right now. There is some light that's probably going to shine at the end of Japan's tunnel. And you know what that light is? Japan has been in a 20-some-odd year recession, and now just about everyone who's out of work is going back to work when they start to rebuild their country. So as horrible as this is, and we know, we hope everyone lives and there's no radiation, but it is what it is, and we can't control that. But there will be some light at the end of the tunnel for Japan, you know, a few years down the road. But hey, our prayers go out to you, Japan. Listen, traders, these markets are flying around with fear based on Japan. Unless there is more radiation being leaked than we know about, Japan seems to be pretty upfront about their information, unlike what Russia did during Chernobyl. Japan has been able to, and I believe truthfully, tell us everything going on. So markets are reacting in a way as if this radiation cloud is way bigger than we're hearing, and I don't think that's true. So don't get too caught up at what's happening on this quick downside panic. Just be careful, keep your powder dry, let these things level out somewhere before you take a look. Now, traders, we're going to talk about the 65% rule in the E-mini S&P. I want to show you some charts right now that will illustrate that 65% rule and show you where we are at this moment in time. Traders, with no further ado, let's look at some charts. Okay, traders, the 65% rule, what is that? For you traders that missed last night's video, the 65% rule is simply this. When you have a market creating a pennant that comes to an apex like this one, you simply break it down into 4 equal quadrants, 25, 50, 75, 100, 100 being the end of it, the final apex. And it starts, of course, back here, so 25, 50, 75, 100. What we have found over our 29 years of analyzing these pennants is that more often than not, you get what's called a false breakout. It breaks out in the opposite direction, and then when it finally comes back into the pennant, it gives you the real breakdown, which in this case turned into a bear flag, which led to more breakdown. But there's the pennant, and here's your pop out, 65% of the area. Now, traders, just to let you know, there's no exact science here. This is more of a fine art. So if it looks like it's around 65%, that is all you're looking for. You do not have to calculate exactly 65%. What should happen next? 65% false breakout. Then around 75%, where this last blue line comes in, you usually get the breakdown right there. So there's an example in the dollar index that happened and it worked well. Let's look at another example. Okay, traders, this was actually sent in to me from an OMNI today. Great guy in our chat rooms, and I'd like to give him a nice little shout out. Oliver, thank you so much for this example. Very nice. Thank all you OMNIacs that sent me tons of examples of different time frames, but here we are. This is the example that we got from Oliver, and he says, Oscar, it worked in euro currency. Look at this. You had a false breakdown right about here, about the 65% mark, and then it rallied up and actually turned into a bull flag. So very nice example, but what I want to show you in these examples is this. You spend several days making a deep dip before you come back up. It usually happens quick, but it's 3 to 5, if not 6 days on your 65% false breakout area. So now that we know that, you seen the dollar broke out for about 5 or 6 days. And down here, you had a euro breakdown at the false area for about 6 days. Let's look at another example. Traders, if you don't think this happens in the S&P, I went back to 09 and found a nice example for you. This is the S&P E-mini chart. Here is a pennant that was brewing, and I broke it down into 4 equal quadrants. Look what happened right around the 65% mark. You had a false breakdown, a nice deep dip, about 7 days, and then you rallied out and took off and just kept going. This works really well, traders, the 65% false breakout rule. Again, you will not find this in books. It is an Oscarism. We teach this at the OMNI Trading Academy. I have been using this for I can't count the amount of years, but I've never seen anyone else even recognize it. Traders, my gift to you, this is what I think we're in right now. Let me show you why. Traders, here we are looking at the June E-mini S&P daily bar chart updated right to the moment before I started this video. We are at the 65% false breakdown area, and as you can see, we're only 3 days down right now. Usually you get that deep dip. It should work its way right back into the pennant and then finally break out up here somewhere if, in fact, the 65% false breakout rule is kind of due to the fundamental that's on the street right now, and of course that would be the horrific things going on in Japan at the moment. That, of course, comes out in the charts always. Maybe that is why we're getting our 65% false breakout now. But remember, this is exactly what we should be expecting. And now over the next couple of days, we should end up back up here, back into our pennant. Traders will know in just a couple of days, of course, if we continue lower, then this doesn't work and it doesn't exist. And what we're looking for is something different. And we'll see what it morphs into. But for now, as technical analysts, we are hunting down a formation that is very familiar to us. And this is what we will expect coming out of this formation. Now, traders, one more chart I'd like to show you, which is an interesting statistic that's beginning to develop over the last 3 years in our stock market. Let's look at one more chart. Okay, traders, we are now looking at the S&P on a weekly bar chart fashion. What I have noticed is there has been a change. How many of you know about the October crash? As everybody worries about the October crash. We've all known about it. 87, there was a big one. Almost every year, sometime around September, October, we've had some sort of a major setback in our markets. I have noticed since the big crash started in 2007, and we ended up crashing all the way down to 666 in 2009, a new phenomenon has taken place here. We now get our setbacks between February and March in most cases. February 2009, we're trading 943. By March, we're trading 666. Jan 2010, Jan Feb, right in between Jan and Feb, we're trading as high as 1151. We break down to 1041. Nice 110 points right there. Next, this year, we are trading in February. We traded as high as 1337.5, and as of this evening, we traded down to 1252.25. Once again, Feb, March, Jan, Feb, Feb, March. It is the first quarter of each year now that we get our setback. That has happened ever since the market's had its reset back down to 666. New market, new plateau, new world, electronic trading environment. We have shifted our big setbacks from last quarter of each year to the first quarter of each year, at least according to what you see here. If that continues, we'll, of course, follow it year after year. And yes, there have been other setbacks, but if you want to recognize something, there was no big setback as big as this, except for this right here, and that is the flash crash day. That's an unexplained day, traders. We don't know why it happened, but we know that it was a technical glitch in the markets. That gave us a bigger setback in 2010. Then did the Jan-Feb swoon. However, without this technical day, this flag would have never even developed, and we would have stayed up here. So I think that we are right. The cycle is now the first quarter of each year. We are now in March. Look at our setback starting, traders. It's almost done, just like you've seen in these past years. Remember that here, this is dramatic because we were coming down from the highs of 1577 on a non-stop crash or elevator drop all the way down until it finally hit 666. So you had a almost 300-point drop during March of '09. But once things stabilized, you got a 110-point drop here. We're not even 100 points, or we're less than 100 points, but I'm assuming that we should break about 110, 120 points here, maybe end up somewhere between 1220 and 1200, and that should be the end of this quarter's setback. We shall see. Those are the targets I'm looking for if, in fact, we continue to set back. That's long-term view, traders. What I just showed you on that 65% rule on those dailies is for what's happening right now. Ignore this. I just wanted to point out a cycle that's beginning to build. So, traders, you've seen those charts, that 65% rule. You better pay attention to it, because until it doesn't work, that's what we're expecting to happen. And then, of course, you saw the cycle that shifted from last quarter, or between third and fourth quarter of every year that I can think of growing up in this industry, to after the 2007 through 2009 meltdown. It seems to have now moved out to the first quarter. We're in it now, and it should go away soon. And don't forget, we have our projection of 1650 for this year. So I'm not expecting a big rout on the downside by any means, just market movement as you'd expect. Traders, one thing about putting this on the board last year, right around this same time, I put my projection for 1290 on the board, and we dropped 150 points and still made the projection of 1290. This year, I put the projection on the board. We're down 80 points already. It's perfect timing. It's almost poetic. Let's see where that goes. All right. What else? Traders, this grassroots movement, I am not kidding. If we scream loud enough, maybe they'll hear us. I want some help. I am sure most of you would be in my corner on this. If not, you're probably own an oil well, and too bad, you have delivery to make. It is time for you people to stop destroying our economies. Traders, help me out with this. Write to me. Let's get this movement going. Keep your emotions out of trading. The best way you can do that is to say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.